All right, welcome back, founders. We're here for part 2 of stress testing our numbers. We're joined by Neil the Numbers Pro, Neil Jones, Senior VP with Financial Recovery Services with BDO Canada. So welcome back, Neil. Portion number 2, you're still with us, so that's great. Now, you had a perfect segue for us because in our first segment, we were talking about stress testing. We were talking about building the pro forma. And so once that is done, and once we've looked at a couple different scenarios and situations that might come up, you led us into now understanding that outside of that forecast, we should be testing some key ratios that will help us better understand exactly what the health and viability of our business look like. So what would those key ratios be and how do we go about doing that?
So the key ratios, it depends on the type of business, obviously. And when I'm asked, I guess when I think about where I would start, I think the best place to start would be understanding the agreements that you have with your financial institutions and what debt covenants may be in place. And often financial institutions would include ratios as part of their covenants. For example, current ratio or quick ratio. They would be examples of what I would call liquidity ratios. They may also include what I would call leverage ratios, which examples of those that I often see would be debt service coverage ratio or debt to equity, which is a leverage ratio. Some people call it a gearing ratio as well.
Okay.
So to start off, current ratio is essentially current assets over current liabilities. It's essentially also a way of looking at the health of working capital. Generally, if there's various ways. Sometimes there's different ways people calculate this ratio, but to simplify it, it's usually current assets divided by current liabilities. And if the ratio is higher than 1, then essentially, more often than not, your current ratio or your liquidity, your working capital is in a positive position. Sometimes banks or financial institutions may take it a step further and look at the quick ratio. And the quick ratio is essentially the same as the current ratio, except from the current assets, you remove inventory. And inventory is often considered to be less liquid. So it's a way to, kind of similar to how it's named, but a way to assess liquidity with more liquid assets. So cash, securities, AR over your current liabilities.
Okay. And so just to clarify, liquidity, solvency, right? Ability to service debt and to stay operational.
It's more, I guess, looking at the company's ability to finance its working capital. So it's more the current part of the balance sheet.
Okay. And so then when you're talking about doing these calculations with ratios, we're using present day numbers, not necessarily the forecasted numbers.
We would use, you can use either. So you would want to assess it, your company's financial performance. So how performance actually, I guess, unfolded. Yeah. So it would be past, but in your projection, you'd also want to look, given current trends and assumptions that you have built into your projection, you want to build in, based on those projections, how would the company's ratios be impacted?
Okay. And then just to clarify, assets outside of your quick ratio where you take out your inventory, how do you recognize asset? It's my understanding it has a specific value attached to it within a year. So you talked about accounts receivable, talked about cash on hand. What else would you consider an asset?
So for the current ratio, it's current assets or divided by current liabilities. And generally current assets are cash and cash equivalents,
Okay.
AR, inventory, and you might see some other items there like prepaid expenses, for example, over current liabilities. And you could keep it working capital focus. So current liabilities would mainly include accounts payable related to your operations. Sometimes the calculation may change, and other current payables are included, like current principal payments, for example, on debt. But generally speaking, it's more often than not used as a working capital ratio.
Okay.
Assess
And
working.
silly question. I know there's no such thing as silly questions, but are we taking equipment and property into account here too? Any equity built up in either of
Generally,
those?
no, not
No.
for the current ratio, not for the quick ratio. Those are assets or equipment is usually considered, I guess, non-current assets would be the proper terminology.
Thank you for that. And so what ratio are we looking at when it comes to quick? Are we looking for that same, the one, higher than one?
If you have higher than one, you're likely in a good situation because you're able to meet your current obligations with your liquid current assets. If it's 0.8, for example, you're probably still in a pretty good position because you do have inventory as well. And obviously a business's goal would be to turn inventory into a final product. It's just a quick ratio is just a way to assess liquidity, I guess, in a more, I guess, with short-term liquid assets rather than looking at something like inventory, which may be sitting in a yard for a certain amount of time.
Okay. All right. So we're doing the quick, we're doing the current, and then what other key ratio do you think is important for us to measure?
Often I see financial institutions use what I would refer to as leverage ratios.
Okay.
So the debt service coverage ratio, that's where you're looking at net operating income. And that is often measured through EBIT, which is earnings before interest and taxes. So essentially you're taking your bottom line, your net income, adding back interest and taxes, and it gives you, it's referred to as EBIT, but it's I guess you can refer to it as a income from operations.
Okay.
That is divided by your debt, your current debt service costs. So that would be interest and principal payments due in the current period.
Okay. And current period is obviously when they're doing this ratio, what they have outstanding.
Yeah, so current period would usually be within the fiscal year.
So, okay. All right.
So, and generally with that ratio, DSCR, if the ratio is more than one, that generally means you're generating enough income from operations to pay your debt costs, interest, and principal. If it's below one, then that's when you're getting into a risky area because you're not generating enough income from operations to pay your current debt obligations.
Okay. So we're looking for below, and you used an acronym there, DSCR. Is that what you said?
DSCR is the acronym for debt service coverage ratio.
Awesome. Okay, so we're clear on that. So we've got these three ratios. Do the math, get the calculations, get your ratios in place, understand where you're at. Now, what is the do we want to call them themes that you're seeing in these ratios, these numbers, and then what do we do about it if these ratios don't look good for us right now? I imagine through COVID, you know, they're probably not ideal. I could be wrong, but what do you see happening quite often when people do this math?
Yeah, and before I get there, there's one other leverage ratio that I do see that I would want to talk about a little bit, and that's debt to equity. I do see that a little bit.
Okay.
A lot of people refer to that as a gearing ratio, but essentially it measures how much of a company's operations is being financed by debt versus equity or in-house sources.
Oh.
So it's on a banks would look generally at that often when they're looking at should the bank invest or loan a company more money if they have a high gearing ratio, meaning they're financing more of their operations with debt, they may be reluctant to lend more.
So startups obviously are going to have, their number's going to be high, right? Because it's primarily operated through debt.
Unless they have a large capital injection or funding, yeah, that could be the case for sure.
Right. Sorry. So that would be equity funding, I'm guessing, right? Because otherwise it's, yeah. Okay.
Yeah, capital injection, I would refer to, say, an equity investor.
Right.
Yeah.
Okay. So
And
for those of
so,
you that are in startup mode, recognize that ratio is going to be a little skewed, but I think you bring up a really good point, Neil. And I know a lot of people, a lot of founders that I have worked with, oftentimes, unfortunately, turn to additional loans as band-aids and ways to make it through. As I'm trying to say, find ways to make more revenue so that you can, get through in business. It's a disservice to just continue to go after loans. And obviously now when they're doing this cost, or when they're doing the ratio, when a lender is doing this ratio, it is going to impact their ability to borrow because the ratio is skewed, debt to equity, right? Or gear ratio is what
gearing ratio.
Gearing
and there's
ratio.
other types of gearing ratios as well, but you can get, with all these ratios, you can get much more complicated. But yeah, often I see financial institutions, if a gearing ratio is poor or higher the ratio, the worse or the more operations are financed through debt.
Yeah.
Often financial institutions would either not lend if that's high, or require a capital injection before they would put more money in the form of a loan.
Okay.
Yeah.
Well, good to know. Thanks for adding that one.
No problem. And I guess you had that segue into common themes. And being a restructuring professional, I do see some common themes from time to time. One common theme, and it's a good summary or tie back to the initial discussion we had about analyzing historical trends and creating a sound financial projection. But I often see companies coming to me and saying, here's my reviewed financial statements. I'm not making money. I don't understand why. And the financial statements may be 6 months old. It's, often to wait for an audit or review, it's usually dated information. So I often see companies don't have up-to-date financial information to help them make sound financial decisions. So that's probably theme one. So as much as you can, roll your sleeves up, get dirty with get your hands dirty in Excel. Yes. and try to stay on top of your financial projection, comparing actuals to projections on a monthly basis.
That's huge. That's so important. I absolutely agree. It's 4 months after year end when they look at the document, right? And they're like, oh, we didn't even come close to hitting the profit we thought we hit.
Exactly. And sometimes companies might, if it's a smaller company, might not know how the year ended until that statement is or at least know exactly how the year ended until that statement's produced.
Yeah.
So timely financial information is one theme. Another theme I see often in times when companies are in financial stress is reporting to the financial institution goes dark. So companies are feeling pressure and they don't report. And that obviously makes financial institutions, what's the proper term, nervous.
Mm-hmm.
They want to understand how the company is performing, and so they may take action. So I guess my advice there would be, even if you are performing poorly as a business or not as well as you did in the past, it's always important to report. And there are ways you can improve reporting as well. Instead of just reporting financial performance, you can report also restructuring steps that you've taken to date. You can report restructuring options that management is analyzing and looking into to determine if those steps would improve financial performance going forward. So there's ways to report that would I guess, signal to the financial institution that, management's on top of this, and they're doing the best they can to try to manage the situation.
I think you bring up a really important point to just clarify for founders. I know that some of them are going to be listening to this saying, well, my only obligation really is to, or in their perception is that their only obligation is to repay the principal and the interest based on the terms of the agreement. I know with my lender hat on, it was every 3 months we were looking for that specific report, show us what the projection was, how you're meeting projection, or how you're pivoting going forward. But for those lenders who have not defined a reporting process that gets attached to that loan, I appreciate what it is that you're saying, because I think that many, even in the event that they're not able to pay or service that debt, they go dark, like you said. But taking a proactive approach, and before you get to that point, even if they haven't requested the report, reach out to those account reps that you signed those agreements with, and just say, listen, we're doing the math. So that's going to be a pleasant surprise for most of these lenders to start off with. We're doing the math. Here's what it looks like. Scenario 1, scenario 2, scenario 3. What can we do? What are the workarounds if we do find ourselves stuck in some of these scenarios? So, how we started this off, that proactive approach to your numbers and your finances. So that's really valuable.
Usually a requirement within debt agreements is to report at least annually. I've seen quarterly reporting requirements, and if a company's performance deteriorates compared to historical trends, then banks may require more frequent reporting, like a monthly report, for example. Okay. And obviously those statements wouldn't be reviewed or audited. It would be right. Internal financials.
Exactly.
But there's more, I guess, timely reporting requirements.
Beautiful. So yeah, staying on top of it, right? Which is the point that you were talking about, staying on top of your numbers, getting those numbers in, not waiting till 3 months after year end to look at the notice to reader, to file the report. What kind of came to mind, and I don't know if I should bring it up, but I will talk about it in case anybody else has experienced this. I have a few clients who their loans have been called, even though there were terms attached to them, right? It's overnight, we need the 1.5 back. And I don't know, obviously that's a scenario to potentially plug in to that first segment that we talked about. But I don't know, in your experience, Neil, is there any way to mitigate that risk of having a loan called despite you maintaining or keeping up with the agreement?
Meeting your covenants are important. Maintaining reporting to your financial institution, very important. Financial institutions can often be almost like a team player for a company. They will work with you, even in times when things might not be going well. If you're honest up front and taking proactive steps, I've often seen financial institutions working with companies to help them turn Beautiful. Things around. What you ask about the demand loan is a good segue into the third segment, where we get into restructuring options. But I guess some of the other common themes that I would see, if a company does have liquidity issues, so if you're at the stage where creditors are knocking on the door asking for payment, if you're falling behind on payment, you're not generally able to make payments as they become due, that's when you want to get into a more detailed cash flow projection. And that's where, if possible, you're creating a cash flow by week. I know that sounds like a lot of detail, but by week, and generally we would recommend for a 13-week cash flow, which is generally 1 quarter. But that's also a very valuable tool. When you get into liquidity issues, having that detail for a cash flow projection will allow, what it does is allows you to understand when the cash crunch will happen. It may happen, say, in week 4, week 5. So you can plan for that. So you may be able to manage your working capital a little bit. You might be able to try to collect AR early. You might be able to negotiate alternative payment terms with your suppliers. But you understand when that cash crunch is coming, and you are able to plan for it. You may also know, if that's not an option, working capital management, you might be able to know when and how much you need to go seek additional financing, because that could be an option, or how much you need for a capital injection to get you through this cash flow crunch. So I think cash flow projection, different from the financial statement projection, but in times of liquidity challenges, that cash flow projection is valuable.
Do the math.
And another theme that I've seen in I guess experiences has been what I would call a borrowing-based calculation, or a financial institution starts requiring margining for a line of credit or a revolver. So you might have a company that, say, has a line of credit with $1 million limit, and the company uses that revolver or line of credit to manage working capital.
Happens all the time.
You might see certain triggers. It might be a period of time. It might be some other trigger where the bank, say, at a certain time requires a borrowing-based calculation or a margining requirement. And in those circumstances, the financial institution would change the amount of limit on your line of credit for each month going forward based on a calculation, borrowing-based calculation. And that calculation is often, what I've seen in the past is often determined by good AR and inventory.
So Neil, I think because this has happened probably 6 or 7 times this year for me with clients that are like, all of a sudden my line of credit is impacted. I don't understand what's going, especially with a lot of it seems like a lot of financial institutions now will issue these visas too, and the Canadian Emergency Business Account. Got these visas and they're like, I used to have access to this much. Now I don't have access to this much. Now they're calling this. So what I'm hearing you say is, so that business owners and founders can really understand this, what is happening is that these lenders have been looking at your usage of that line of credit, and then depending on the receivables or the revenue that is coming in, and through COVID, I would imagine that for many business owners that has started to dissipate. So this is affecting that ratio, which is now triggering. It's probably just an automatic trigger. It's probably, it's just an algorithm that goes, and it starts to decrease that access to that line of credit that they thought they had. And so now this is further compounding the stress. So that is called the margin.
It's what I would often call a borrowing-based calculation.
Borrowing-based calculation.
Or a margin requirement. And it may be simple as time. A bank or financial institution may provide a line of credit that for the first year is a fixed limit, and then after year 1, it moves into that borrowing-based calculation requirement. And usually, what I see, like I said, it's based on good AR and good inventory. So it would be AR under 90 days, for example, and a certain percentage of inventory. I often see 50%, because inventory is a little harder to age.
Is it turning over inventory? It's just inventory.
It's inventory that would be turning over with your natural.
So they're taking all of that.
Yeah, and obviously that line of credit balance or limit, would fluctuate month to month based on the previous month's borrowing-based calc. So if you can see how this can compound an issue, because if revenue is starting to be impacted by, say, COVID measures or COVID response measures, and revenue is going down, that impacts your AR, which all of a sudden impacts your borrowing limit, and it's almost like a domino effect.
Yeah.
So it's something to really watch out for.
So it comes back to this message of being proactive, staying on top of your numbers, taking ownership. This isn't something that we delegate out. This is something, to your point of that weekly cash flow. Founders I know would rather go to the dentist than look at their numbers every month, but this is what it's getting down to, right? And this is really the opportunity that COVID's presented us with is, the more often we do this, the more comfortable it becomes. The more comfortable it becomes, the better off everybody's at. So let's wrap this session up. I know there's a lot of information there for everyone. What I do want to say, what I've taken away from this, Neil, is obviously lots of extremely valuable information with respect to the ratios and that weekly cash flow, staying on top of these numbers. We looked at lots of considerations, but not going dark, communicating. And as you were talking about this too, I know this is why you are here and your team, you're here to help people through understanding this math, understanding these options. And of course, the episode champion came to mind, Community Futures, right? These are lenders. And oftentimes we, as founders, we don't turn to lenders until it's last minute, but especially offices like Community Futures that are there to support you through this, right? They're friendlies in all of this. They're advocates. They're there to make sure that businesses sustain through COVID. This is the win-win-win. Our community needs it. Our country needs it, right? We need small business and we need our economy to turn back up. So it doesn't do anybody any good if businesses are shutting down. So just please, please, please do the math, own your numbers, take ownership of it. Okay, so that's a wrap for segment 2. Thank you, Neil, for staying the course with us. We're going to come back for segment 3, which is really about reinvention and when we can turn things around, how we can turn things around, what are the options? If these numbers aren't looking good, what can we do? And how can we see it through? So thank you, everybody. Before I forget, if you look at the show notes below, you're going to see Neil's contact information. You're also going to see information to reach out to your Community Future office. And please, please, please download the tools. We don't have the weekly cash flow, but we do have a monthly cash flow. You can replace months with weeks. That's an easy fix. So don't let that be your scapegoat for not doing it. That's super easy. All right, we'll see you back here for segment number 3, which is all about our reinvention. Bye for now.